So let me tell you a little bit about the speaker that we have today. The Chugh firm is an annual sponsor of TIE. So thank you very much. We have a number of people from the Chugh firm present here. Raise your hands if you belong to the Chugh firm. It's a growing organization, I have to say. And I just came to know that they're expanding to a bigger place at the end of this year, which Navneet will tell you probably a little bit more about. But Navneet Chugh is the managing partner of the Chugh firm. He's an attorney at law, a certified public accountant, and has an MBA. The Chugh firm provides corporate tax, litigation, immigration, employment, and M&A services to emerging growth and mature companies. It has been in business for 28 years. I first came to know about it when I was helping out with Save-a-thon, and Chugh firm graciously donates and gives their time to nonprofit organizations like TIE and also ICC and Save-a-thon. So we had the pleasure of working with them, and they do a really good job. They have a staff of about 240 employees with 102 attorneys and CPAs, and they have offices in various different locations, including Atlanta, Los Angeles, Santa Clara, and New Jersey, Washington, D.C., and also India. So many of you entrepreneurs might be interested in expanding businesses to India. So they do have offices in Bangalore, Chennai, New Delhi, Mumbai, Chandigarh. So Mr. Chugh is on the board of the TIE Global, and also he's part of TIE Silicon Valley, a charter member here. He's also part of Pratham, a nonprofit organization, HAB Bank, Ignify Consulting, India Community Center, Asia Society, and Premier Media. He's also the member of the Young Presidents Organization. In 1997, he founded the TIE Southern California. I didn't know that. See, this is news to me. TIE SoCal was founded by the Chugh firm. And he also founded the North American South Asian Bar Association, or NASABA, NASABA, a nationwide body with 27 chapters in North America, representing over 10,000 Indian lawyers in US and Canada. So he has a string of accomplishments behind him. So we are very, very glad that he is here to talk to all of you all today. So please do join me in welcoming Navneet Chugh, as he will tell you more about how to run your business and life in perfect legal and tax fashion. Thanks, Navneet.
Thank you, Dipti, for the wonderful introduction. So that was pretty much the whole speech, so we're done now. You had food, dessert, wine, and the commercial. Good evening, everyone. Welcome. A lot to talk about, a lot of good stuff to cover. But my preference that we do this in an interactive fashion. All of you are in Silicon Valley, which means all of you should know about corporate tax, litigation, immigration, employment, M&A. We read about it every day. Business is life in Silicon Valley. San Jose Mercury News covers more business than any other newspaper in the world. You wake up in the morning and the first news item is about Apple and some fight he's having with Tim Cook. I'm convinced that there is no purpose for this fight except for publicity and branding for Apple. Why wouldn't you pick up a fight with the United States government? If Donald Trump can pick a fight with the Pope, then Tim Cook's not going to be far behind. So I want to talk a little bit about business and talk a bit about how to set up a company in a proper fashion and optimize it for tax purposes and for immigration purposes and litigation purposes. And I won't go into any details, and I won't bother you and have you rack your brain. But I'd prefer if we do this in a wonderful interactive session. And we will not wait for a Q&A at the end. You can interrupt me anytime and ask any question. I am delighted this evening that a lot of people here are doing startups. I remember meeting Vinod Khosla. He came and spoke at Thai Los Angeles in March of 1998. And he says, we were just discussing odds and ends. And he says, why is it that every time I meet an Indian person, they give me 2 business cards? So I told him it's very simple. One business card is their 8:30 to 5:30 job, and the other one's their startup. So I sat down on the table, and the first person I say hello to, he says to me he's no longer where the badge says he's working on a startup. And met another person, he says, I work here, but I'm working on a startup. So that's great. The startup industry is live and well and kicking in both United States and India. The rest of the world is suffering. Brazil is, Europe is, China is. So the good news is that there's only 2 places that are not struggling and are doing really well, and that's India and United States. So it's 3 people running the world now: Obama, Modi, and God. OMG, right? So I read an article this morning, and it kind of disturbing, but I thought I'd share it with an intelligent audience. The article was, what 10 things destroy your wealth? And I know Thai is all about creation of wealth and entrepreneurship and sharing information and education and creating startups and creating wealth. But one of the things I want to cover with you today is how, because we're new in this country, other immigrants have come before us, the Europeans 400 years ago and 500 years ago. And because the Indians and South Asians are new in the United States, it takes us a while to figure out the gimmick. And we've become very good in creation of wealth. I think the next chapter for all of us to learn is to make sure we don't destroy it. So I'll talk about how not to destroy wealth and some other communities that came before us, and I don't need to name them. Between 1840 and 1920, 500,000 Europeans migrated to the United States every year, 40 million people between 1840 and 1920. That's what the bulk of United States that you see today. If you get a chance, look at the nationalities of people in United States. So 49 million Germans and 40 million Italians and 36 million French. This is what, when people in United States are asked, what is your background? These are the answers they give. Indians in 1965, before immigration opened up to Asia, or Asians, in 1965, there's some estimates that there were 1,200 Indians in United States. The first Indian having come to United States in 1896. There's even his name published. I don't know how they got that information, but it's very exciting. So because we're new here, we need to worry about not having our wealth destroyed after we create it. But I'll talk about this later, but I thought it'd be an interesting way to start. Here's 10 things that destroy people's wealth in the United States. What do you think is number 1? Litigation. I like you. The only reason you said that is because you don't use us. People who use us, they never say that. We win every case. What else? What do you think?
Bad investment.
Bad investment.
Debt, divorce.
Ruby? What's your name? Rohit.
Rohit.
Okay. I figured I could go on for half an hour and nobody in this room would guess the number 1 answer. And that's because we're Indians. And yes, Rohit, the number 1 answer is divorce. And from that point of view, we're kind of lucky so far. The country average is that 40% of marriages end up in divorce. Indians is about what, 3, 4, 5%? And increasing, of course. Our office does 100 divorces we have. But we specialize in CEO divorces. No point getting poor people divorced. What's the point? If there's no wealth to be split, what's the point? So, and when I get phone calls from people that the total assets are 3,000, I remind them that several bus spots have divorce 299, so maybe they ought to look there. But yeah, divorce, 40% of people in this country, marriages will end up in divorce. The single largest wealth destruction, because it's obviously more expensive for two people to live separately than together. And along with the divorce, the other factor that causes wealth to get destroyed is living single. All right, number 2, and this is not necessarily in any order. Number 2, credit cards. Number 3, impulse buying. Number 4, no budgets. Number 5, not having a diversified portfolio. And I love the last one, but we'll get there in a second. Not saving for retirement, staying single, and not focusing on pre-tax returns, always focusing on post-tax. And Vivek, do you agree? Mr. Merrill Lynch? All right, and here's my favorite, the last one. I love this one. Not making enough money. So we'll talk about making enough money and making sure wealth is not destroyed. So the number one thing that any business does in the United States or anywhere in the world, 31 million businesses in the United States, the number one thing every business does is creates value. So when you do all your startups, and half of you are thinking of doing startups or in one, or have a startup that's gone ahead and matured, the number one thing is to create value. And the only other thing you need to remember to do is manage risk. After you've created value, which is the gist and genesis of every business, then we need to manage risk. And how do you manage risk? First thing you do is set up a business properly. And if you're setting up a business in California, then certain things have been discussed and debated for many, many years. 10, 15, 20 years ago, when we would get a client, we would have a discussion of sole proprietorship versus corporation. And those days are gone. If you're going to do business in the United States, and especially California, you must be incorporated. No more sole proprietorship. We set up a true legal entity, give birth to a separate legal entity, so that if something happens to that separate legal entity, it does not affect your personal financial situation and doesn't affect your personal financial assets. So we set up a corporation, no brainer. Now, again, ages ago, we would talk about S Corp or LLC or C Corp or partnership or LLP. We've all grown up and matured, and so have you. We don't have those discussions as much anymore. It's pretty simple. If there is going to be real estate involved, you will set up a LLP. If there is going to be a foreign shareholder, then you cannot do an S corporation. If you have to have more than 75 shareholders, you cannot do an S corp. If your LLP is only available to doctors and to lawyers and accountants, so most of people in the room cannot do an LLP, so LLP is out. If you're going to raise funds, then you're going to be a C corp, because VCs don't like any other form of entity, because they don't want a pass-through entity that gives out K-1s at the end of the year. So there's all your answers. Did I not cover anything?
Partnerships?
Partnerships are out of fashion because LLCs happened about a dozen years ago in California. So partnerships have unlimited liability, so that's why nobody does partnerships anymore. Can't remember the last time I did a partnership. The only reason we do partnerships if there's real estate involved, but now we have LLCs, so that's out. No partnerships. What did I not cover? Yes, Sanjay.
The S Corp is the default way if you are not required to do a C Corp.
I would agree with you. A regular corporation is not the default way. If it's a lifestyle business that you are not going to seek funding for, then S Corp is the default way. Or you can come talk to me for 2 hours and pay me $1,500, and we'll, at the end of 2 hours, come to the conclusion that we should do an S Corp. Thank you for ruining my business, Sanjay.
Succession planning, G.
Succession planning.
That's
Yeah.
where the money goes away. They were talking, their answer was litigation.
Right.
And it's because you're trying to pass on a
Right.
business where now you become a partner of the widow.
Right. You know, we live in a very bad country. One of the few countries in this planet that has a death tax. So in United States, you cannot leave behind more than $5.4 million to your kids, to the next generation. In India, you can leave $500 billion and there's no tax. So that's why if you look at the Forbes 400 richest people of United States list of 30 years ago and 20 years and 10 years ago and now, there's very few people that are repeated and are there that were there 40 years ago because of death tax. In India, you could look at the list 100 years ago and now and next 100 years, it's going to be the same list. The Tatas and the Birlas and the Ambanis, and life will go on, no death tax. Which is kind of unfortunate. Hopefully India picks up on what US is doing. There is no reason to not have death tax because statistics show that by the time the fourth generation happens, the money is all gone. So there should be death tax if you want to equalize the income in a country. So, and I'll come back to succession planning in a bit. So corporations, simple answers, S Corp, unless there's real estate, then LLCs. If you're requiring funding, then C Corp. Stay away from partnerships, unlimited liability. Now, the theme of the evening is wealth creation and avoid wealth destruction. So we're going to stay away from anything with unlimited liability. And sole proprietorship and a partnership are two forms where there is unlimited liability. So we'll stay. Yes, Rohit.
What about the holding company? Creating a holding company.
Yeah, so one of the nice rules to have in life from a business point of view is simplicity and neat and clean stuff and not many entities. Try not to do 2 entities and 3 entities and 4 entities. They serve no purpose in the long run. You need 4 websites and 4 HR managers and 4 set of contracts, and then it's like a corporation has a 1% chance of getting audited. So now instead of buying 1 lottery ticket, you bought 4 lottery tickets in the IRS audit box. So now you have chances of getting audited of 4%. So unless there is a pressing need, I would stay away from holding companies and second set of companies. I would set up divisions. With software now and technology now, it's very easy to have one corporation, and within that one corporation have 7 divisions and 7 sets of financial statements, but one entity, one tax return, simplicity. Yes?
In that model, is it okay for that corporation to do business in 5 different lines of business, like real estate, all the way to software development?
Right. A good question. Is it okay for that one entity to be doing 5 lines of business? Yes, it is okay because it'll help you with bank loans. The bank's very happy that this entity has so much wealth. From a litigation and liability point of view, not a very good idea. We would, if they're in distinct lines of businesses, then we should try to do separate companies. If they're in the same line of business, then there is no point doing a separate entity. For instance, there was this famous case in New York. One guy had 55 taxis, and he put up each taxi in a separate corporation and had 55 corporations, and then he killed someone and then went to court, and he said, well, I have this one corporation that killed this person, so the other 54 are not responsible, and the judge says, get out of here. I am creating a new legal theory. This is a famous case, yellow taxi cab company, whatever. I'm creating a new legal theory called the enterprise theory, and all 55 of your corporations are in the same business, and the only reason you set up these 55 companies to avoid liability, not going to allow you to do that. It's one single enterprise. All 55 are responsible. So within the same line of business, creating a separate entity doesn't make any sense. Having a separate division makes all the sense. Real estate should not be put in a C corporation because of double tax. Once you sell the real estate, first the corporation will pay tax, then you will pay tax. And the other reason you don't ever want to put real estate in a regular business, and you won't be able to because no bank will finance it. The banks want, if you want to put your real estate property in an entity, the bank wants no other asset in that entity, because so that when they foreclose, they're the only ones that have a right to go after the property. So most LLCs we create that house real estate, and they're getting a loan. Our documents say it'll be a single purpose LLC. The banks force you to write that in the bylaws, in the operating agreement, that this XYZ LLC will be a single purpose LLC. A good point. Yes, sir.
Which state to incorporate in, California or Delaware?
Yeah, everybody has this question, right? Which state to incorporate in? So bad lawyers tell you to incorporate in Delaware. And, and I know I'm going to hear some objections in the room.
Well, Delaware lawyers tell you to incorporate in Delaware.
Yeah.
Nevada lawyers tell you to incorporate in Nevada.
Right. And I don't know if there's any lawyers in Delaware. That's the other funny thing. Yeah,
There are
registered
judges.
agent. If you're going to be a public company, then the laws of Delaware are better in support of management and not in support of shareholders. And the trend has been that if you get that big and you're going to go public, then you can reincorporate in Delaware. The single largest thing missing in this topic is you can incorporate anywhere you want, all 50 countries we have in this wonderful country. But if you hire an employee in California, or you take up a lease, or you do business in California, you have to incorporate that Delaware company back again in California as a foreign company doing business in California. So now you have two corporations, a Delaware company and doing business as entity in California. So then you have two tax returns and all of that extra work. Very rare that I will ever do a Delaware corporation. If there's an investor investing and they insist that it must be a Delaware corp, then happy to do Delaware. But so far I haven't come across any advantage. Massive disadvantages of being in Delaware. California has a franchise tax, minimum tax of $800 a year. Every state has a franchise tax or a state income tax, $200, $500, 2% of this, 3% of that. Delaware has a franchise tax which is based on assets or the number of authorized shares you have. So what a lot of startups will do, the legal Zoom startups that we love, they will incorporate in Delaware and put 100 million stock as authorized stock, and then they'll get a bill from Delaware of $400,000 as franchise fee. And I have seen many of them and I've had to fix them because they didn't check the box that I want my franchise fee based on assets, and the default is or was authorized shares. So here's a $400,000 bill, which you can contest and cry a little and Delaware will waive. But that's one problem. Number two, we end up with litigation, and sometimes because the corporation is Delaware, our clients not knowingly set up a contract and they put jurisdiction as Delaware, and now there's a lawsuit. And if I'm representing the defendant, the plaintiff is very smart. They want the lawsuit to be adjudicated in Delaware. And now, what am I supposed to do? Fly to Delaware for court hearings, hire a lawyer in Delaware, and there's not that many lawyers in Delaware, and then they're very expensive. So you get set up in these traps with Delaware and Nevada. If you want to run a clean, wonderful business, which is the only way to make money in the long run without having to go to jail, then California is the most beautiful state to incorporate in. Since you live here, you're going to have to incorporate in California anyways, and you're going to have payroll, you're going to hire employees, you're going to have an office. So some things in life are a no-brainer. The 6th largest economy in the world, let's just incorporate here. All right, so we incorporate properly. And then the important thing with the corporation is that it's a separate legal entity. It's as if you gave birth to a human being. Now this needs to be fed and taken care of and a tax return filed. And the courts and the law says to you that we are allowing you to set up a legal entity, and run it in a separate business. And if things don't work out, you can file for bankruptcy and you're done, finished, and you owe people millions of dollars, no problem, you don't have to pay them. And this is a country where we allow you to start again, so you can start again with another corporation 3 days later. And you can't file bankruptcy for a few years again, but okay, you can. Donald Trump's filed 4 bankruptcies, our next president, maybe. I was in India a couple of weeks ago, and all my clients in India are concerned, is Donald Trump going to become president? What's going to happen to immigration? I said, nothing's going to happen to immigration. He has a wonderful talent of changing his mind every few minutes. And so once he's in the White House, we'll see another Donald Trump if he ever makes it there. So, you can file for bankruptcy and get a new start. And if you run the corporation properly and you owe people millions of dollars, you can shut down the corporation and not have to pay anybody anything. Now, the court and the laws of this country say that if we're going to give you such a huge advantage that you can just wash your hands off and turn off the corporation in 2 minutes and shut it down and move on and not be responsible, we need for you to do a few things. And those few things are, the government says and the law says and the court say, that you need to take care of this corporation. You need to respect it. You need to treat it like a separate company, a separate entity. And if you violate any of the respect the corporation rules, then we're going to remove the umbrella of the corporation on your head, and you shall be subject to all of the liabilities of the corporation. So what are these respect the corporation rules? So in California many years ago, in a court case associated, a judge ruled that if I see any of these 20 factors or any combination of them, I'm going to rule that the corporation doesn't exist. I'm going to pierce the corporate veil, remove the corporate umbrella, and you shall be personally responsible. So here you're going along, taking on debt, signing on contracts, and have a lot of liabilities, and you're running a corporation, and you think it's okay, nobody can come after you. You declare for bankruptcy, and then stuff happens. And if you violated these 20 rules, so we have to respect the corporation. Every decent corporation in the United States and California, all of our clients, we make sure that they respect these rules. If you respect the corporation, treat it like a separate legal entity, you will get all the protection. Rule number 1, you will not treat the corporate checkbook as your personal checkbook. You will not treat the corporate bank accounts as your personal bank accounts. You will not treat the corporate credit card as your personal credit card. You will not give loans to the company without a promissory note with interest. You will not take money from the corporation without a promissory note, without interest. You will not do commingling. You will not do fraud. And you will not have 4 entities and money moving from one entity to the other with no minutes, promissory notes, interest reflected on the tax return, note payments being made on time, and you will capitalize the corporation adequately. So if you set up a legal entity, given birth to a new baby that's going to do a new business, you should start the business with enough money so that the intent on day 1 is not to shut down the corporation and cheat people. So you can't start a steel plant business, new corporation, and fund the corporation with $100. That's called undercapitalization. And Supreme Court of California in one case ruled, in one case the corporation was capitalized with $100. The judge said, I don't even want to look at anything else. I don't even want to look at the other 19 rules. $100 to start a corporation, to set up this business. Even a psychiatrist business requires a sofa and a table and a phone. And so the $100 is not enough. Since you undercapitalized it, I'm piercing the corporate veil, and I'm holding you responsible for all the debts of the corporation. So send me an email. I'll send you this list of 20 factors. But basically, it boils down to running the business in a neat and clean fashion. Have a separate credit card that you just use for the company. Have the credit card bill go to the office, not to your home. have the company write the checks to your credit card, take proper payroll, just like you pay all your employees. And I've shared this with some of you. I have a rule at my corporation that you will not see a single check made out to Navneet Chugh besides my payroll. I refuse, no matter how much money the company owes me, I will get reimbursed, I'll do whatever, but the IRS auditor is not finding another check made out to me, which is not something I can say about a lot of entrepreneurs and businesses, including some of our clients. But everybody else at the office gets a payroll on 15th and 31st, and so do I, and that's the end of it. I have a credit card that I use for business purposes only. The bill goes to the office pays. I don't look at the bill, I don't see the check, it just works out just fine. So that's how, and it's very easy to do. I know it seems complicated. Well, what about this $5 parking I paid? Yeah, fine. Collect all these receipts if you want to. And at the end of 3 months, give all the receipts to your controller or your spouse or whoever is running the affairs and get reimbursed, or just eat the $5 and not worth another check made out to you from your corporation. But if you start operating like this, you'll figure out ways to have all the proper expenses go through the company and not do these individual transactions. Questions about, I usually have a lot of questions about on this credit card. Yes?
All the people have credit cards?
A lot of people have credit cards. The partners of the firm have credit cards. All the office managers have a credit card, but it's a separate credit card than the one I use. And I think we have 4 or 5 different credit cards, one for the accounting unit, one for the legal unit, one for the office manager, one for the partners. But all of the bills go to the company writes a check, and all the expenses are trapped through the credit card or any other way, but not checks made out to you. Just refuse. Just make it a point. I'm not writing a check to my own name. Very easy. Yes, sir.
If it's an S corp, what's the right way to take a dividend?
To take a dividend from a S corp? So S corps can't give dividends. I mean, I know what you mean, but technically the dividends are only through a C corp, and dividends can only be issued once the corporation has profit. You pay taxes on it. After the taxes are paid, there's retained earnings. Dividends can only be issued out of the retained earnings. S corp is a pass-through entity, so when you have $1 million of revenue and 600,000 in expenses and 400,000 of net, that net is yours to take, or all the shareholders to take. And you can take a salary, or you can take withdrawals at the end of the year or every month or every quarter, and keep an accounting of what happened to that 400,000. But a lot of S corporation mess up their accounting records and don't keep it neat and clean. It's very easy to keep it neat and clean. There's 400,000 of profit. Take a $400,000 check. If you've taken 300,000 during the year, take 100. Take a salary so that the profit is not 400 to begin with. IRS gets very upset when you don't take salaries because they're not getting Social Security tax. And by the way, the good things in life you want to do, the pension plans of the world, you can only do if you take proper salaries, and you can only do if you do things properly. So when people don't do things properly, they miss out on the most wonderful legal tax deductions available in this country. Yes?
In a related thing, that if you have a profitable C corp, is it better to take money out as dividend and or to pay yourself a high salary from tax point of view?
Well, congratulations on making a lot of money. If the business has plans to grow and you will require more capital down the road, then it's good to leave some profit in the company and pay the corporate tax, 30%, whatever, 40% California and state. And then you have 60 cents left for growth purposes, because unfortunately this country's laws say that if you want to save money for growth, you have to pay tax. So you earn $100,000, you pay $40,000 in tax, and then the company has $60,000 left for growth purposes. The alternative is you take a salary of $100,000, pay $40,000 in tax, and then give a loan to the company or take more equity from the company and put the money back into the company. So IRS does have a problem if you take a huge salary. If you take a $3, $4, $5 million salary, IRS has this issue of unreasonable compensation, and they attack small company shareholders that take a huge salary because they say, well, part of this is dividend, so they want a double tax. So in your case, without knowing all of the other facts, I would say do 70-30, 80-20, 90-10, 60-40. And first of all, you're the one who said default is S Corp, and now you have a C Corp. What's going on?
Share with us.
Okay. Get rid of the C Corp. And it's never too late. I know it's 18 years old and this and that. Start one today, S Corp or an LLC. Slowly transition over, and the C Corp will die, and you will not have this question anymore. What's the other reason to have a C Corp? You have other shareholders that want a C Corp?
No, we thought we'll get investment, we didn't need it.
Okay.
Profitable.
Right. So I convert to C Corp when the investment is about to happen. But okay, so the investment didn't happen. So you got stuck with a C Corp. Not too late, because 5 years from now we'll be having the same problem again. So might as well. Yes, Rohit.
So the question is, when you have a C Corp, isn't it true that you pay taxes, additional franchise taxes on the revenue? Or, well, I think on the LLC, so that's a good reason to have a C Corp?
The tax you pay on the LLC is very little.
On the total revenue
Right,
for the
but it's very little. And a S Corp has a tax as well, a small tax. And that gross revenue tax is far better because it gives you liability protection. That's the price you pay for not having a partnership but an LLC.
But isn't it a good reason to convert that LLC into a C Corp?
Never a good reason to convert anything into a C Corp because of the problem he's facing now. The double tax, unreasonable compensation. In an S Corp, you can take a $10 million salary, the government's not going to say anything to you. In a C Corp, you take a $2, $3, $4, $5 million salary, and the government has a right to attack you. Maybe not in Silicon Valley, but the rest of the country. But I would never ever convert a LLC to a C Corp unless you're about to get funding and the funders insist that you should be because they won't invest till it's a C Corp. First the lady, then I'll come to you. Yes?
So if you had an LLC and gave a loan to your company and forgot to do a promissory note or didn't know to do a promissory note, can you do that?
Yeah, the good thing about almost every area of law in this country, this state, is if you haven't done anything, if you fix it later, it's all forgiven. And far better to fix it than to not fix it. You gave a loan, you have now a choice to convert the loan into equity and never take it back. If you think you're not going to see it back, please convert it. Otherwise, you have interest going back and forth. It's not only the promissory note, the LLC must pay interest to you, and you must report that interest as interest income on your tax return. If you don't and you get audited, the IRS auditor will impute the interest. We'll say, okay, I don't care you took it or not. I am giving the corporation a interest break, a deduction, but you have to report it on your personal income tax return. That's the power the auditors have. And to you, they're not going to do anything but if it's a right set of facts, the government has the power, and they do it often. Interest in this country is so holy that if a father gives a son a loan without interest, the IRS auditor imputes interest. Says to the father, where's the interest income? Hard for Indians to swallow that, I know. Yes.
So in S Corp, you're saying you could take the profits as you go along. If you have residual money, do you have to record that as some event, some sort of note, or you? I mean, at the end of the year, you're going to file a return. I'm not filing quarterly, so I have a profit at the end of the year besides a salary.
How are you living on a daily basis? You're taking salary, right? You should take salary. I mean, the reason I say that is that if you're running a decent business, and this is a mistake a lot of entrepreneurs make, many entrepreneurs, and I did for many years. If you started up a business and it's making money, who is the first person to get paid?
The officer, okay.
You should be getting the first person to get paid. But if you're not taking a salary, then maybe you're getting paid and maybe you're not.
You know, there's sometimes cash flow is there, sometimes not. So you can't record a check, you know what I mean? Like, I can't have the cadence of the check coming in, but I take money if there's profit. Not, then I leave.
I won't say it to you, but I've said it to a business person saying, why don't you shut down the business if there's no money to pay you? What do you mean there's no cash flow? There's cash flow to pay everyone else on the planet. What about you? So if you run a setup where the payroll checks are coming automatically and everybody's getting paid and you're getting paid just like your employees, somehow the cash flow gets managed. You give a loan to the company if you have to, but your paycheck is holy. You have to take it.
I have a paycheck. It's
Good.
limited. I'm talking
Okay.
about if.
Extra.
Right.
Right. So extra, you could take a monthly distribution, a quarterly distribution.
Right, okay, so those distributions, are they just, I mean, is it a bank, I mean, it is a bank transfer, it's a check to me from the company, but I'm asking, is there any recording of done in terms of, for IRS purposes or any tax, you know?
It's a very good question. I've never had anybody ask me that. Kisle, what's the answer?
Yes, you have to do recording in your shareholders account. It is recorded as a distribution. End of the day, it is your money because you are paying taxes in your personal tax return, so you can withdraw. I mean, you just have to record it properly.
Right. No minutes, no required. It's not a unusual transaction. It's your money. The government's waiting for you to take it. You want to take it now, you take it. If you want to take it a year from now, you take it a year from now. We have some companies that are big companies and maybe 100 million in revenue and have 20 shareholders, and it's an S corp, so all 20 shareholders get distribution at the end of the year. But the company needs money to grow. So what the company does is, if it was a C corp, they would have left the money in the company and paid taxes. But because it's an S corp, the shareholders get a K1. So the company has a policy. They give all of the shareholders 50% of the money that's on the K1 so that they can pay their taxes and then they have some pocket money. 50% of the money is retained in the company. And so every year, all the shareholders get a piece of paper. At the beginning of the year, your balance was 1 million. During the year, we had 200,000 in profit. Here's a check of 100. Now at the end of the year, it's 1.1. Without you realizing, maybe on your tax return, this accounting is being done on page 4 on M1, M2. But it's nice to be very cognizant of this number and keep it neat and clean. S corps, it gets very messy till you do it properly. Yes?
What precautions you need to take when you have a consultant working in India for an entity in US? How do you make the payment and make sure that it's properly?
Consultant in India? How do you make a payment? Yeah, that's a good question and we get asked often. And it's surprising, the answer is shocking, and it's you write a check to the consultant and you send them the check or wire them the money. And it's amazing that in United States, the government is okay with you making payments to employees to foreign countries. Advise the Indian company to get incorporated, and so it's even better. Does the answer seem a little odd?
The question, because they are not giving you the SSN or the EIN or anything.
Right.
So that's the TIN number, nothing is there. So
Right. So India's software export revenue in 2015 is 100 billion. So Infosys and the TCSs of the world wrote all these hundreds of millions of dollars of checks to Infosys India every month.
I'll add one line. Actually, you may take a form called W8BEN that is equivalent to W9.
okay.
And you can take it from the foreign person, and that is nothing but exemption certificate from the withholding, just like W9. So that will help you.
Can you reduce your corporate income tax using that?
Sorry?
Or his taxes or whatever his liabilities can be?
The Indian persons, right. Just like you would give a 1099 to a US person and the consultant's problem. Yeah.
I have a C corporation, partner is there. I own that corporation through a LLC.
Okay.
Is there any advice on that?
No advice except for are we paying a little extra tax on the LLC?
How?
Does the LLC get income from the corporation?
Yeah, potentially.
Yeah, okay. Unless there is a compelling reason to do it, I would just keep life simple and just own the stock in the corporation. It's not going to give you any additional liability. You can't go to court and say, I have two entities.
No, but my other business, I don't want to do that corporation.
Right. So then I would strongly advise you to not do it like that, because if LLC or the corporation ends up in legal problems, the other entity is attached as well. Like if I'm the attorney on the other side suing you, I'm going to tell the judge or jury, Your Honor, I can't tell the difference between this corporation and this LLC. It's all commingled. One owns the other. They do transactions. And since the LLC owns the corporation, the entire asset of the corporation is now part of LLC. So if the LLC get attacked, your corporation's now unnecessarily gotten attacked. Now, it's also a violation of all we're talking about, to keep businesses neat and clean and to avoid liability of one falling on the other. So if there is a good reason, then tell me. I want to learn. Yes, sir.
So for tech startups that run a loss for the first 1-2 years, is it better to treat the loss as loss, or I know there's a kind of a R&D tax rules,
Right.
or better to put it as an R&D to the asset side, because I think I have some friends running into that problem.
Right. So yeah, a tech startup or any startup, there's some losses to begin with. What do you do with those losses, and what's the right way of structuring it? So now the issue is, in your group of startup investors, is there a rich person that could use those losses? So if there is, then we try to structure it so that that person benefits from the losses. And to begin with, the company is in that person's name, or as there is a higher stake. Or you figure out other ways so that somebody benefits from the loss. If you do a C Corp, the loss has gone to waste till there is income in the future. And most startups, they don't have any other income. So even if they get the loss by doing a S Corp or a LLC, they can't use the loss. So a lot of startup losses go to waste. And if you can do the R&D and capitalize, that's one way to not have losses.
So what's the benefit of R&D capitalized? Then you would never get the benefit of the losses, but you have assets on paper, right?
Right. So if you start a startup, if you start a startup today and you don't have any other income and you lose $100,000 this year, and I'm doing your taxes and I say, hey, you lost $100,000, what are you going to do with that loss? You don't have any other income to offset it with. But if I say to you, hey, let me capitalize these costs, and the loss goes down from 100 to 10,000, then we can use the 90,000 in future years. So that's the benefit of R&D. Push the losses in future years when you have income. Yes.
So you said you have a lot of protection with a legal entity, but when you go for ask for a loan, banks would ask you to sign as a personal guarantor,
Right.
even for as S corp. So
Right.
what is really the protection here? Because once you sign an agreement as a personal guarantor, aren't you fully liable for that? Even if you run
Yes.
in good faith and then after let's say it doesn't work out, you want to liquidate it. Where do your personal assets stand, or how far of a liability you have?
So if you create an entity, C Corp, S Corp, LLC, LLP, it's a separate legal entity, separate taxable and separate legal entity. And if you take care of it and respect it and don't violate the 20 rules, you get this umbrella over your head. So you could file a bankruptcy tomorrow and owe people millions of dollars and clean it up and no liability. You could have a massive litigation lawsuit against you worth $10 million and you could file for bankruptcy. But if you go outside this umbrella and put your hand outside the umbrella and sign a piece of paper with a bank saying, I will be personally responsible, then you are personally responsible. So if you stay within the umbrella, you get the protection. But often small businesses, to get a bank loan, have to sign a personal guarantee, which is fine. You're only responsible for the bank loan. But the $10 million litigation loss or a bankruptcy still protects you. So as much as possible, landlords will ask you for personal guarantee, refuse to sign it as much as possible, pay $100 more, or sign on to personal guarantee, but have a line up in the lease agreement that at the end of 2 years, my personal guarantee will evaporate and vanish. That in 2 years, you now know, as long as not one of my checks was paid late, I've given 6 months of rent in advance, so I don't have to sign personal guarantee. So do whatever possible to not sign personal guarantees. So it's the banks and the landlords that cause the most trouble. Banks are hard to, unless you become big and huge and have massive assets, then the bank will operate differently. Yes?
Can I suspend and resume SBAR?
Yeah, you saying, can you suspend a corporation and start again?
Resume it
Yeah.
later.
Yeah, it's a beautiful country. Yeah, I guess we can do that. So what happens is, if you don't file your tax returns and stop responding with the state of California, the Franchise Tax Board and Secretary of State, they'll suspend your corporation. And if you want to revive it 2, 3, 4, 5, 6 years later, you can revive it, but the state says pay us $800 a year. For the last 6 years, you didn't pay. 800 is now 1,100, 1,900, so you pay 6 times 900 or $1,000. Then there's a $250 penalty for not filing the Secretary of State paperwork. So this revival is going to cost you $4,000, $5,000, $6,000, $7,000. And then I'm going to say to you, like, hey, why don't we just start a new corporation? What's the benefit of? If you want history, then sure.
Yeah, so can I then report zero revenue and pay that $800?
Yes,
How long? I mean,
forever. California is very happy to get your $800. Yeah.
so but then I cannot claim any expenses, right?
You can claim it in expenses. If it's an S corp, you can even write off that 800. If it's a C corp, then the 800 is dead, buried in the corp. If it's an LLC or an S corp, you can write it off. $800 plus the accountant's fee of $2,000 that you'll pay me to file the tax return with zero. Yeah. What else? Okay. Yes.
At the end of the year, from a S corp, or when you declare certain amount that needs to be given to the shareholders, right? But then you need to write a check and then give the amount, or can the amount still be in the company account? Because if you write a check, then it becomes zero balance, right?
Right.
What matter is that?
You're free to do whatever you want. Your corporation had gross revenue of $1 million, expenses of 900, 100 of net. That net is yours. You can write a check, not write a check. That one company I told you, they have 20 shareholders. They write a 50% of the check every year. It's an accounting you need to keep within yourself, and it goes on the tax return. I have yet to see a S corporation tax return on which that accounting was accurate, ever. It's just people find it difficult to take money or do this, and so we fixed a lot of S corporation returns, but it's not that difficult, and it's not that bad. It's not that lethal that we can't fix it. There's no tax ramification that much. Why do you want to keep the corporation alive with zero? There's something going on?
So when I started at S-Corp, I was like a consultant. So I worked as a independent contractor, and then I switched over to doing full-time job. And then I thought I could make some money out of, the part-time job or whatever, and that never happened. So I continued my full-time job. So I'm just reporting zero revenue and then filing taxes regularly. But I think at some point, IRS may come back.
No, they won't come back, but you being too good of a citizen is what the problem is. Most people wouldn't file a tax return and wouldn't pay the 800. And the proper thing to do is to dissolve the corporation and fill up some paperwork and file it, and the company actually gets dissolved. The Indian way of dissolving is to not do anything. And all the non-Indians in the room are laughing, but But you get the notice from the franchise tax board, you trash it. You get a letter from the Secretary of State, you trash it. And this goes on for 4 or 5 years, and then the state says, okay, forget about it. This guy must be Indian, let's write off this. Let's remove the corporation. Honestly, at least 100 times or maybe 200, we've done this. Somebody calls and says, I need to shut down this corporation. It's not doing anything. We're filing this return, and I want to dissolve it. I'm like, okay, fine, we'll dissolve it for you, $1,500, $1,200. And they're like, oh, now more money. I said, okay, you don't want to pay, don't pay. Don't dissolve it. What about this FTB notice? I trash it. Once a year, I get an email, hey, I got an FTB notice, and I respond back saying, basura, then, which is trash, right? And 4 or 5 years later, the notices stop. It's a wonderful country. Several million corporations get done in California every year. I think half of them are never used. So the Franchise Tax Board and Secretary of State is like, okay, forget about this. Life is going on. There is IBM. Okay, there's 10 of these. Forget about them. No problem. Yes?
In an LLC, there is two versions, like you can file as a partner or an S corporation.
Right.
Yes. So what is the advantages of partnership in S corporation within LLC?
Well, there are reasons why LLC wants to be taxed as a partnership, which is the true sense. But there are times, a thing I should cover is that all LLC, S Corp, C Corp, LLP are separate legal entities given birth by the Secretary of State of California. They're separate legal entities. Only one of them is a separate taxable entity, the C Corp. The S Corp, the LLC, the S and the LLP are pass-through entities. So if there is $100,000 worth of net profit, it goes to all of the partners. So if there's 3 partners, 33% each, they get a K1, a piece of paper saying, hey, you have a $33,000 profit or loss. So it's very simple, but it kind of, this one sentence simplifies things. So LLC, S Corp, and LLP are pass-through entities. Only the shareholder is taxed once. The C Corp is the only animal in which there's a corporate level tax. First, the corporation pays tax, and then if the shareholder dissolves the company or whatever, there is a second level of tax. So there's instances where the LLC doesn't want to be taxed as a partnership, then we tax it as a corporation and pay the corporate tax.
Because we have a real estate business. So in this partnership, when you want to file the income tax, so to show as real estate as an asset or not, depending on that, it is filed as a partner, as or S corporation. That's the reason, which is advantageous for real estate.
I would, if it's an LLC holding real estate, I would just tax it like a partnership and a pass-through entity and let the K1s go to all the partners. Hopefully there's a loss on the real estate that maybe some partner can use. If you do anything else, then the loss may go to waste. Yes?
LLC can also be a sole proprietor agency.
Yes, it can, if there is only one shareholder. Right. Yes, sir.
If someone who has done no estate planning work, what are the top 2 or 3 things that you would like people to know here about estate planning?
Estate planning. My first piece of advice is to forget about estate planning and don't do anything, which is not you're ever going to hear from a lawyer. That's my new style these days. I discourage people from doing estate planning, and I'm partly being serious and partly not. But here's the deal. I want all of you to go tonight when you get home, go to this website called livingtobe100.com, and it asks you for 20 questions, and you answer them, and it's going to tell you when you're going to die. And which is why you came here, right? And so the number is going to shock you. A while ago, there's a very famous cardiologist, Dr. Anil Shah in Newport Beach, and I was having lunch with him. He's 70 years old, working, and long conversation, but the line I want to share with you is, so he says to me, Navneet, you will get sick, but we're not going to let you die. You come to the hospital, we're not going to let you die. And so the biggest problem later on, all of us are going to, or most of us are going to face, the fortunate ones that are going to face later on in life is we're not going to die. So if you do this livingtobe100.com, the answer is going to be 90, 85, 95. Regine, who runs my Santa Clara office, where is she? I asked her to do it. Can you stand up? 103. So I asked her to do it, and then she calls me the next day. She says, Navneet, what's the retirement age at our firm? So I told her I'd never thought about it, but now that you're asking me, and now I know your answer of 103, the retirement age is 90, and the last 13 years you can do whatever you want in life. So the reason I talk like this is that we need to change our attitude about estate planning. Everybody's idea, let me leave money for kids, let me transfer 5% of my corporation to my daughter, and let me transfer 2% of this real estate to my son, and then my grandson and my daughter-in-law, and this and that. Forget about it. Please do not give anything to your kids at all. Stop it. Because you gave them birth in the United States, that's the biggest gift they got, and that's all they deserve. Where were you born? Where were you born? Right? And so next, if we can die and not be a burden on them financially, that's a huge gift. Right? So if you're going to live to be 100, who's going to take care of you? And are we going to ask our daughter and son and daughter-in-law or whoever to take care of us? And so if we're going to need to be taken care of, which means we got to hire assistants and $3,000 this and $2,000 this and assisted living and nursing home at $10,000 a month, I don't know what. But we will worry about leaving money to kids later on in life. But the attitude needs to change. And I have to tell you something shocking. What do you think is the age of most people in the United States when they get their parents' money? 55. The kids, most kids that get your money, our Indian parents' money, the kids are 55. At that point, they should be worried about their own estate planning, let alone. And and we're ruining our kids' lives also. I told my kids 2 weeks ago that, listen, he gave you birth in the United States, that's it. And Ritu, my wife, and I are going to make sure we spend all of the money before we die because we're going to live long. Plus, even if we're not living long, we're going to spend a lot of money on doctors and hospitals to make sure we live long. And then we're going to hire these dietitians and nutritionists and personal trainers to make sure we live long. So you're not going to see any money, so forget about this and take care of your lives. Now, the reason I said this to my kids, and you must say it to your kids, is if you don't, they're just waiting for your money, and they're not thinking that they're going to be 55. And how much can you enjoy life after 55? What are you going to do? Can't eat steak, right? Can't go to Kilimanjaro or whatever. And so get them off of this thing. Live your own life. Figure out how to make money, and don't be waiting for us. When we die, you're going to be 55. And so reduce their dependence and anticipation of inheritance so they can start focusing. Yeah, Rohit.
Is there any advantage in a living trust?
Yes, there is. Now that the not so serious part of estate planning is over, yeah, if you have significant wealth, so now between you and your spouse, you can leave behind $10.8 million tax-free to your kids, to whoever. So there's 3-4 very simple rules, and I know most of them you know, but I'll just repeat. Number one, between husband and wife, there is unlimited marital deduction. So when Bill Gates dies, and he's going to die first because he's a guy and all men die before women do, statistically 6-7 years throughout the world, and then most Indian husbands are 3-4 years older than their wives. So I keep telling my wife that put up with me because the best 11 years of your life are coming towards the end. So unlimited marital deduction. So when Bill Gates dies and whatever he's worth, 30, 40 billion, if he leaves it to his wife, no tax. The wife dies next day, beyond $10.8 million, 40% tax. So between you and your spouse, you have 10.8 million to leave behind, tax-free. Okay, that's rule number 2. Rule number 3, which we need to pay the most attention to, is every year you can give $14,000 per year to anybody on this planet, gift tax-free. And I don't need to tell you that gift tax is a separate animal than income tax. And gift tax and estate tax is the same thing. It's unified. Gift tax and estate tax means the same thing. $10.8 million you can leave behind on death or while you're alive. So if you're on the deathbed at the hospital, you can give $10.8 million to somebody, no tax. Or you can die the next day and leave $10.8 million. That's all you're allowed to give away or die with. Yes?
Can you give more than one gift, 14,000, and still it is tax free? More than one people?
You can give $14,000 to 7.4 billion people on this planet. Yes, but one person, one gift, maximum gift of $14,000 per year. With the spouse, $28,000. So if you have a son and he's married, then you have $14,000 you can give to your son, $14,000 to daughter-in-law. Your wife can give $14,000 to son, $14,000 to daughter-in-law. So that's $56,000. So if you have assets more than $10.8 million, please use this $14,000 a year. And remember earlier I said, please don't give anything to your kids. This is the only exception, $14,000.
So from what age can you give this?
Very good question. Starting day 1, when they're 1 day old, you can give. Till they turn 18, somebody else needs to be a custodian of the money. So you open up a bank account, you put $14,000, your spouse puts $14,000 on day 1 of their life, there's $28,000. You put it in a trust, a custodian account. It's called a crummy trust. And you set up a 1-page trust document that I've set up this trust. Vivek will help you. He'll do it for free. I charge. He works at Merrill Lynch. Now you just need a custodian to handle the money. You can't be, because if you are, then you haven't really given away the money. The control must pass. So your uncle, your cousin, your whatever, your brother-in-law, if you like him, whoever. So that's from day 1. Once they turn 18, you can give $14,000 to them directly, since they're an adult.
Do they pay tax on that?
No. So Bill Gates could write you $1 billion check, no tax to the recipient in the United States. Gifts, the donor's problem, the donee gets it tax-free. Very few things in life that are tax-free. So back to estate planning. So rule number 1, unlimited marital deduction with spouse. Rule number 2, if you're over $10.8 million, the government's going to take 40%. Rule number 3, $14,000 per year per donee, anybody in the planet. You can write a check of $14,000 on December 31, another $14,000 on January 1. Rule number 4, if you are worth over $10.8 million, you should have a living trust. What a living trust does is it avoids probate. Otherwise, all 3,058 counties in the United States have a probate court, a separate court that if somebody dies, somebody needs to go to court that, hey, this Ram Babu is dead, here's his will, no will, and the judge looks at it and oversees the procedure. It'll take 6, 9, 12 months, and there will be a cost of 3, 4, 5% of your estate. Marilyn Monroe died without a trust. Her probate documents are public. You can Google them, and how many fur shawls she had, everything had to be disclosed. It's all open if there is a probate. So you don't want to do probate for time, money, and publicity. And so all we do is do a simple trust, and the trust is another corporation like Animal. So you take everything you own and you dump it in the trust. So when you die, somebody goes to court and the judge says, what did Rohit own? And the answer is nothing, Your Honor. And the judge says, his house, Your Honor, the trust. His bank account, trust. Nothing. So he had nothing, no, Your Honor. Okay, go home. And the trust says what to do. You have a successor trustee, and you made Sanjay the successor trustee, and the trust document says, hey, after I die, please do the following. Give the money to my kids, give it to my spouse, no. Yes, sir.
Navneet, if you have less than 10.8, then will is not required because you can, the remaining children will take it with tax-free, is that true?
Yes.
That's what I am understanding.
Trust is not required if you're under 10.8. I would still do it. If you're sitting in the room, you should have a trust because if you're not worth 10.8, you will be one day. And plus you're educated, and Justice Earl Warren, Supreme Court, United States Supreme Court Justice died without a will. So you don't necessarily have to have a trust, but a will you should still. And you could say, I don't need a will either, because California has a will for every single person in California. So if you die in California without a will, without a trust, the government has written a will for you, and that gets stamped on your dead body, and it says half to your wife, half to your spouse, half to your kids. But it's public, it'll get probated, the judge will oversee, it'll cost you time and money and privacy. So yes, do a trust. Simple, yes.
Is there an advantage in having your trust or your C Corp as well?
Remember when you died, Rohit, and I went to court and the judge says, what does he own? And I said, nothing, Your Honor. So you can't own anything. You create a trust, you dump everything in it. Your real estate, your bank accounts, your stock investments, your corporation, C Corp, whatever stock certificate, you remove the stock, do a new stock certificate, remove Rohit, and put Rohit Trust, and that's it. You own nothing. Yes. Yeah, that's the beauty of it. You take the trust, tear it up, and put it in the trash can, and you're done. Because the trust doesn't get registered with any government. California has a will for you. California has a will for you under the probate code, but yes, it will work. A will written on a toilet paper was ruled valid, but it'll be probated. Wills are probated. A judge will oversee, is somebody cheating you? Are you cheating someone? Is everybody getting their fair share? The dead person's wishes are being accomplished. The judge will oversee. 1 second, Vivek.
So if you have a trust, you get a double step up in basis, right? If you have a husband and wife, husband passed away, all the cost basis gets stepped up for the wife. Is that correct? If you have a trust, community property.
Right. And so as part of the trust, what we do is do a community property agreement and call all of the assets as community property, and yes, you get a step up. Yes, sir.
So you said as per the California will, so for default will, the wife gets half and the children get half, but if it's community property, automatically belongs to the wife, doesn't it?
Right, but if you wrote a will, you could have left everything to your wife.
If it's community property, it stays with the wife.
Half of it. When you die, half of it is yours, half is hers. So for all estate purposes, who's not happy with his wife owning half? So for estate planning purposes, we have a mental picture when somebody dies. We take a picture of everything they owned. One half belongs to the living spouse, one half belongs to the dead spouse. And the dead spouse's half we now need to take care of. Was it over 5.4 million? Then we need to pay taxes if he didn't leave it to his wife, and so on and so forth. But yeah, half community property. Yes?
What about the situation that you don't have any relatives in this country?
I have give you my card. Yes. Relatives abroad is fine.
But how do you give it to them and not to the government?
Just put their name. And trust me, they will find out.
Do you have to do a will here or a will there?
Will here. Wherever your assets are, the will must be done in that country. And trust me, people say, how will this person find out after I'm dead? They figure it out. Yes, in there.
How expensive is probate? Does the trust have to file a return every year?
No, living trust does not. IRS says we're ignoring this living trust. your social security number, the house mortgage is in the trust's name, the house is in the trust's name, you're claiming the mortgage on your 1040, IRS says we have nothing to do with this piece of paper. We're ignoring it. It's for estate planning purposes, we don't care. Yes?
How expensive is probate?
3 to 4% of your estate. It's not pretty.
So it's better to do a living trust.
Plus 6, 7, 8 months, plus somebody having to go to court. And the trusts are easy to do. Yes?
So you said when you create a trust, everything goes into the trust. You don't own anything.
Correct.
So does it help you against litigations and stuff like that also?
So IRS ignores the trust, and so do the courts. For liability purposes, you need to do a different kind of trust. There is the living trust is a revocable living trust, which means you tear it up and throw it in the trash can and you're done. For asset planning purposes, we need to do an irrevocable trust, and the underlying principle of an irrevocable trust is that the control over the money left your hands and went into somebody else's hands. Since you don't own the money and you don't have any control over it, if there is a lawsuit against you and there's a judgment, the person who has a judgment against you can't touch it. But irrevocable trust means that we take $1 million, we put it in a trust, we take your house, put it in an irrevocable trust, and now you need somebody else to be the trustee of the trust, and that trustee could run away with the money or whatever, but not that they're going to. But that's the kind of thinking for asset protection. And really one life to live, and we have a few dollars, and now we're going to put it in an irrevocable trust and give somebody else. Better than that, we respect the corporation and follow the rules and don't violate the 20 rules. That's the best asset protection. I have clients come to me, we did a trust in Nevada and the house is in Wyoming, and we have this LLC in Utah and this and that. And they say, so what do you think? I say to them, pay me $10,000 and I'll rewind and undo everything that you paid for, because it serves no purpose. And the courts and judges are very smart, and they see all of this and they make you undo it. So, so over $10.8 million do a trust, and then so the other advantage of a trust is you can say, you put all your assets in a corporation and you've made somebody else the trustee, and you can say, after I die, everything goes to my spouse. After my spouse dies, give everything to my kids, but don't give it to them right away. Give it to them when they reach certain ages. So of the hundreds of trusts we've done, the most common ages are 22, 26, 30, 34. That's because of our conversations with our clients over a period of time. Somehow I suggested to them, and that's become the default. So what most of the rich people, and most of our clients are rich people since we don't take poor people as clients, but most of our clients, we having them leave money to their kids at age 26, 30, 34, 22, 26, 30, 34, 22, so they finish college. And then, and again, if you remember the 55 rule, that your kids are going to be 55 before they see your money. So when you do a trust and have the money go to your kids at 22, 26, 30, 34, their ages are long past. So the only way this age thing comes in the middle is if you die early, if there's a premature death, or both spouses. So, and so most of these provisions are kind of useless. Hopefully they'll all live long. And by the time somebody opens the trust, they would be long beyond 30, 34, and they'll get the money when the parents die. Yes?
So I have a living trust, but I didn't add the corporation to it. Can I add it now? And what would be the mechanism to do it? Can I do it myself, or I have to go back to the
You can do it yourself. Just take the corporation's stock certificate and the one you have right now, cancel it, put big canceled on it, issue another one in the name of the trust, and that's it.
So what I see is trust is basically just a recording document, inventory of your assets, and just kind of recorded in one place. Is it more than that, or is it pretty much that's what it is?
That plus you save on probate fees, plus you save on time, plus you save on privacy.
Right, but in terms of what it is,
Yes.
I know what it will do.
Right. In terms of what it is, everything you own has been dumped into this vessel, into this entity, which is not a separate legal entity, but is just an entity, and has a trustee, which is you, and has successor trustees, which...
But again, it has no registration, it's
No.
not linked anywhere, it's sitting
No.
with you personally, you wrote it yourself, or with a lawyer, but pretty much is an agreement between you and, you came up with
Right.
yourself and you recorded it one place. And so just to see it at a point when you're not around.
Right. But something important has happened, which is that the title of all your assets has moved away from your name.
Another part that has that.
Right. That is being recorded with the government authorities. Your house deed is no longer in your name, it's in the trust's name.
But that was it, other than that, what else? The real estate assets got moved.
Bank accounts?
Okay, if it is over a certain amount.
Yes, maybe. If you have a checking account of $1,000 and then you win a lottery of 100 million, you get the check, you deposit it in your checking account, which is not in your trust, and then you are so happy in celebration that you drink a lot and you die, and now your biggest asset is, and this has happened, by the way, I'm not just saying this. So I tell clients, put the checking account in the trust also. You don't know what's going to happen when. And now the biggest asset is not in the trust, so you got to do probate.
Well, wouldn't you put just in the account, the beneficiary of the trust?
Sorry?
In the account beneficiaries.
In the bank account beneficiaries?
Right, wouldn't you list that's the way to do, right? You list the trust as the beneficiary.
No, the account is in the name of the trust. Yes. The account holder is, if it's in your name, we're going to have to probate it. Because when the judge says, what did he own? We're going to say one bank account, Your Honor. And the judge is going to say, how much money? You say, over 100,000. The judge says, okay, probate it. So that you go to the bank and ask them, your checkbook should say your name, trust, and you as trustee. All bank accounts, all stock brokerage accounts, all corporate stock, and anything else you own. You got to be able to go to the court and say to the judge, Your Honor, this guy didn't own anything. Everything in the name of the trust. Yes?
So bank accounts, even if you have in your own name, you can specify your spouse and children as beneficiaries. Doesn't that avoid the probate process for those bank accounts?
Who's opened a bank account in the last few months that somebody asked you that question, who's the beneficiary?
I opened and I specified my spouse and kid as beneficiaries.
I see. That's good that at least you put your spouse's name. But you know what? You opened either by mistake or on purpose or having a conversation with the banker, and that's why I asked you as to who's opened an account. You opened a POD account, payable on death account. If you open up a POD account, is the only time the banker will ask you who is the beneficiary. That account doesn't need to be probated. If you have contracts in the state with other people, with other institutions, and there is a beneficiary there, that does not get probated, because as soon as the death happens, the beneficiary kicks in. For example, life insurance and the POD account. So when I have somebody very simple and they don't have a lot of assets and they just have one bank account, and I say to them, go open up a POD account and you're done. So for whatever reason you had a POD account opened, please go tomorrow and cancel it. You don't want to source death, right? Why are we opening payable on death accounts at a young age? Somehow you opened one, and maybe the banker said something, and he said, yeah, I'd like asset protection or whatever. And yes.
The irrevocable trust does offer some protection, some legal.
A ton of protection. That money is gone from you. Yeah. So if I have a judgment against you, you say, I don't own it. So, but you remember, you just gave away. And remember, you're going to do livingtobe100.com tonight, and you're going to live to be 94. I don't know why we're giving money away to anyone. Get insurances to avoid liability. Lots of insurances. The biggest drama in all of your lives is the car. And the biggest thing you could ever be hit with is if you kill someone with your car, and especially if you're drunk. And so get as big of a auto insurance as you can get an umbrella policy of 5 million, 10 million, 20 million. Of all the expenses that you pay in your life, pay the most amount of attention to insurance premiums. And that's a way to make sure that our wealth is not destroyed. And if you have companies, follow the rules. Don't do 20-factor violations, and be adequately insured, and don't get drunk. And if you get drunk, call Uber, and you're set. Yes?
Do you have any book recommendations?
Book? Okay. On what topic? Right. You guys, Sanjay, you have a book?
No, I'm asking any advice on saving taxes.
On saving taxes, yeah. So anybody read a great book on financial planning? Vivek? Yeah. So I would recommend, there's lots of books, but how old are you? You're kind of young, right? Under 50?
Yeah.
Okay. Just being safe. So I would go to this CFP organization called CFP, and it's Certified Financial Planning course. It's a 2-year degree. Wonderful. Since you're gonna, and I'm being serious. It's 6 subjects: estate planning, pension planning, taxes, investments, and a couple more. And you do it over a period of time. You pass all 6, you get a CFP degree. And wonderful books. And the reason I am saying this is that you're going to retire at age 55, 60, 65, 70. And my dad retired a few months ago at age 87. And so when you retire at age 65, and tonight you're going to find out that you're going to live to be 103, what are you going to do for 38 years? So all of you, we're having fun, of course, but all of you, the last 20, 30, 10, 15, 40 years of your life, you're going to be left with managing money and making sure your wealth is there so you have a minimum standard of living. And all the surveys say that you need about 50% of what you earn now to live the way you're living now in retirement. So since you're going to be doing managing money for 38 years, you have a lot of learning to do on how to manage money and financial planning. And forget one CFP, you need 10 of them. Constantly you should be going to courses on how to manage money, how to do real estate is one of the 6 subjects. And it's a bare minimum. All of you should have a CFP. Sorry? Or talk to, no. Yeah, okay, talk to one.
This is succession planning, right?
Right. So, so you'll do a CFP? It's very easy. And it's fun. And there's classes. You don't have to study on your own. You take the exams whenever you want, 6 subjects, and you are a CFP for the rest of your life. Certified Financial Planner. Then you can give the rest of these people, especially her, who doesn't want to do it and wants to talk to one. So you are doing. Okay. Then you charge people $150 an hour for financial planning. Yes.
Suppose you don't have an umbrella policy, policy taken. So, I mean, you're not drunk and you didn't, you admit the accident. And, how much you are liable, are you personally liable for the amount that is covered, beyond the amount that is covered by the insurance?
Were you texting your girlfriend? That's the question that'll be asked to answer how much damage is on you. That's what it is. Were you reckless? Were you driving unreasonably? Were you doing something else? Were you watching a DVD? Were you watching a movie? Were you on the phone? Were you texting? You hadn't slept the last 2 days and you're still driving. Those will be the issues that the judge or jury or the insurance companies will look at. And if you're not doing any of that and it's just an accident, then nothing. Reckless driving is all. And if you drive recklessly and you're texting and you kill someone, you're going to be in jail for involuntary manslaughter. So beyond wealth destruction, there's other dramas. That's why I said the biggest drama in all of our lives is the car. Since we don't work in dynamite factories and we're not managing dynamite companies, so this is it. Yes?
Any other ways to prevent litigation or manage it better?
Yeah, I'm glad you asked that because that was my next topic I wanted to cover. So to not have wealth be destroyed, we want to avoid litigation. And one of the best ways to avoid litigation is, of course, we talked about having an entity. But the next best way of doing business and avoiding litigation is to have things in writing. And for whatever reason, not only just Indians, but business people all over the world, we have this propensity to not put things in writing. We do verbal agreements, we do verbal partnerships, we mean well, and then 3 people enter into a partnership and they come to me and say, do you have a partnership agreement? And they say, well, no, we haven't discussed it yet. And it's kind of uncomfortable to discuss it. And I think to myself, it's uncomfortable now. What's going to happen when the 3 of you hate each other? Are we then going to write an agreement? So whatever it is, just as policy, do all business agreements in writing, especially the partnership and shareholder agreements. And just because you have a corporation, you should know, as most of you know, that if you do a partnership, we all want to do a partnership agreement. But when we do a corporation, we forget to do a partnership agreement within a corporation, which is called a shareholders agreement. So just because you did a corporation with 3 people doesn't mean that you don't do a partnership agreement, you do one. And those are probably, that shareholders agreement is probably the number one agreement, the lack of which causes litigation. So insurances, writing, and then the biggest litigation all of you will face in life, besides maybe a divorce, is employment litigation. Since most of us are in the service business, that's the number one litigation you'll face in life, which means that we need to pay 10x more attention to employment matters, which means we will have a handbook, which means senior employees, we will have an employment agreement, which means that you will follow the overtime laws and the rest period and meal break. The biggest litigation in California is employers not giving lunch period breaks and rest period breaks and not paying overtime. The number one cause of all lawsuits in California. So it's not that difficult, but we just need to get on with it. Let me just share with you one code section and to show you how important this whole employment business, legal law business is. Labor Code 226.4, California, says that when you pay an employee, the pay stub should have the following 7 items on it. Name of the employee, social security number or whatever abbreviated, number of hours they worked, rate of pay, and year to date and taxes taken out and all. The penalty for missing one of these 7 items is $1,000 per employee per pay period. So if you have 100 employees, 2 payrolls a month, that's $200,000 a month. That's how bad things are. So please have, if you're running a business, please have an employment lawyer. please have an employment lawyer do a employment law audit to make sure you're not violating any of these rules. Once you get on track, it's easy to maintain. Yes.
Follow-up question. Is it true for exempt employees as well? For the hours requirement?
Right. Very good question. Is it true for exempt workers as well? So exempt workers, you don't need to put hours. But if you are in litigation, the exempt worker is going to say, I'm non-exempt. That's going to be part of the litigation, default. And if they prevail on that, then now you have a $1,000 penalty for not putting hours because you wrongly classified him or her as exempt. So let me give you 3 days of employment law seminar in 10 seconds. Everybody in California is non-exempt. Let's start with that. Every employee in California is non-exempt, except for 6-7 kinds of people. Number one, a manager who is getting paid 2x the minimum wage and is getting paid on a salaried basis. Any person with a license, a doctor, a lawyer, an accountant, anybody with a license is exempt. If you're making movies and somebody's writing books, artists, creative worker, literature, people are exempt. And computer engineers making over $90,000 a year are exempt. And but before you get very comfortable with computer engineers making over $90,000 are exempt, please read the definition of what California Labor Code thinks is a software engineer, because most of the people that we think are software engineers are not software engineers according to the Labor Code. And so this is it. These 6-7 kinds of people are exempt. And then, of course, one last category, inside salespeople whose compensation is 50% of the compensation is commissions, over 50%, or outside salespeople who are outside the office more than 50% of the time are exempt. And this is very, very nasty. We've had endless litigation about salespeople suing our clients, saying their salary is not more than 50% commission and they were not outside the office 50% of the time, even though when they were hired, their manager told them, I don't want to see you in the office. What are you doing here? But because they're bad salespeople, they're hanging around the office, having breakfast and lunches and reading Wall Street Journal, they're no longer outside the office 50% of the time. And then they sue you. So those are the ways to avoid litigation. But I think employment is the biggest area that we need to be careful.
Is there an umbrella policy for that to cover?
Yeah, it's a very good question. Unfortunately, here's what the insurance company says, that you owe an employee wages, you don't pay them, but you take insurance, and now that you're being sued, you come to us, we cover insurance, we're not going to pay your wages.
It's not about the wages. You don't get sued for wages mostly, right? You get sued for things that you're not aware of.
Rest period, meal period, overtime are all wages that no insurance will cover. All insurances will cover your attorney's fees. Sexual harassment kind of stuff they will cover. Other employment stuff they'll cover. But very few insurance companies, or not very few, no insurance company is going to cover wages. At the end of the day, there's a line in all insurance contracts, which is the most dangerous line. And the line says, if you do something willful, we're not going to cover it. So if you do sexual harassment and you do it on purpose, we're not going to cover it. If you knew you had to pay overtime, you didn't pay it, it's willful, we're not going to cover it. But they'll cover attorney's fees, is all they'll do. All right, what else?
Taxes.
Taxes, yeah. So what was your question? How to avoid taxes?
How to save taxes.
How to save taxes. Right. So very little left on how to save taxes. We used to have long seminars on 50 things to do on how to save taxes in the 80s and 90s. Till Ronald Reagan came about, all the rich people in California had apartment complexes. that they would rent and the depreciation would be a write-off, so they'll make $1 million and would have depreciation of $1 million and tax was zero. And then Ronald Reagan came and flipped all this around, and I remember doing this rich person's tax return. And I'd been doing this return for 10 years and he'd never paid a dime in taxes. Then all of a sudden he had to pay a little bit in taxes, and he says, what happened? I've never paid taxes. What is this? So with regards to taxes, my preliminary line to a Thai audience is, every year you should make a commitment to pay more in taxes than you paid the year before. That's how you know you're creating wealth. So that apart, a client of mine in Dallas, he sold his company for a lot of money, and he was on a television interview. I incorporated his company in 1994 in Dallas, and he sold in 2014 for a lot of money. And he was being interviewed on television, and so somebody asked him, say, hey, what is your secret of success? And and of course, I went to IIT and I do hard work and I have Indian parents. And by the way, I have a CPA, a lawyer in California, who told me that as a rule, I should just pay more in taxes than I did a year before, and I've been following it, and that's why my company became very successful. So it's not a bad way to figure out if you've arrived in life, if your tax bill is more than the year before. But the best tax deduction left is a $1.1 million home mortgage. And if you don't have one, please get one. Move into a bigger house, make a down payment, as big of a down payment as you can afford. It's one life to live. Don't save money. Spend it on your big house. You're going to be living there a very, very, very long time, as you will find out tonight. And $1.1 million of mortgage interest, tax deductible. I tell my clients, who is looking to buy a house right now? Anybody? Yes? Okay. So when you buy a house and you take on $1 million mortgage, all of the people sitting in this room will be helping you pay your mortgage, because you'll get a tax deduction on the mortgage, and then we're your partners. So all the poor people in Idaho and Wisconsin and Mississippi, all the 45 million people in the United States getting food stamps, every one of them will help you with your $1 million mortgage. So that's one. Property taxes are tax deductible. That's number two. And then every year you make a little bit more money than the year before, your mortgage payment remains the same. So every year your house becomes cheaper. Real estate's appreciated 2 to 3% for the last 100 years in the United States. So if you buy $1 million house, you'll be up 20, 30,000. That helps you. And so that's number one. If you own a business, tax saving we have a different attitude. And when you have $1 million of gross revenue and 900,000 of expenses and 100,000 of net income, once the net income is determined, then it'll go to you one day, sooner or later, and you'll pay tax on it. So when you have a business, then we need to optimize taxes at the business end so that the net income that flows through to you, either on W-2 or on a K-1, is the most practical one and the most optimal one. So which means that you're taking care of your business expenses properly, and you have a good business credit card, and no expenses are not being tracked in the business. And amongst our community, the single most unused business deduction is pension plans. And there is 401ks, there's SEP IRAs, and there's Roth IRAs, and there's KEO plans, and there's defined benefit plans and defined contribution plans. Vivek, did I leave out anything? SEP, simple.
Solo 401k.
And then there's some of the plans say about after-tax 401k, not the Roth, but after-tax 401k.
Right. So we have some clients that legitimately, legally, are putting away $200,000 a year in their pension plan. That's $100,000 in tax saving. And I don't need to tell you, if you look at the graphs of how the money grows inside of a tax-deferred plan versus outside, it's a humongous gap 10, 15, 20 years from now. If you start with a 200,000 pension plan that's tax deferred, you just saved 100,000 in tax. Now you have 200 working for you instead of 100. Then the 200 will have earnings of, let's say, 10%, 20,000. That will not get taxed, so that gets accumulated. So if you look at the chart between tax deferred and outside the tax environment plans, it's like a huge delta 10, 15, 20 years from now. But somehow our community is not with it right now. We're getting there, but I would certainly start with that. So optimization of business expenses and making sure you're claiming all the legit expenses and trapping all the legit expenses so that the net income is as optimal as possible. Do the pension plans. Once the net income falls to you on your W-2 or a K-1, then you're left with mortgage and property tax, pretty much. Yes.
Any comment on tax deferred versus Roth IRA and other plans?
If, as much as possible, you should do tax deferred. Roth, if you have extra money and you're not going to get a tax deduction, so it's just a savings account. So you could put away $5,000 in your savings account and it'll grow tax-free, tax deferred, and you can retire and you pull it, not taxed at all. And if you're Mitt Romney, then you put your crazy investments in your Roth IRA and it becomes $150 million and no tax.
So employers also now give 401k with regular 401k versus Roth 401k. So you can actually put 22,500 there in Roth. So what's your feedback on that doing versus regular 401k versus Roth 401k?
Vivek?
So it really depends on your tax bracket that you're in right now. For a regular, in addition to what you can do, if you're under 50 years old, you can do $18,000. If you're over 50, if you're over, you can do $24,000. So it really depends what tax bracket you're in. If you're making a lot of money right now, you probably want to do the pre-tax. But for the younger guys in here that are making like the 90,000, 100,000, you probably want to put into the Roth 401k, let it grow, and then when you get in the upper tax brackets, then switch over to the pre-tax 401k.
Good.
Okay. Anybody interested in opening companies in BVI, Mauritius? Yeah, Rohit.
Yeah, I would be.
Right. So a couple of years ago, the G8 met, and the first topic was taxes. And thanks to big data, all the countries and all the governments are figuring out how many millions of dollars is not being taxed in any country. And you know what US is up to with FATCA. And if you have a foreign bank account, you must report it. And thanks to big data, all of the countries, including India, have figured out that there's a lot of money that's not being taxed. So the next plan for all of these countries is to figure out a way to trap all of this income that's not being taxed. So 156 countries have gotten together and signed a pact that they're going to share information. So the good old days of BVI and Mauritius and Cayman and Cook are coming to an end slowly. US, by the way, refused to sign this 156 country treaty. They're like, hello, we came up with FATCA, we did our own thing, now you guys are late in the game, you do what you want to. We will only take information, not give it, so we're not signing. But I'll tell you a shocking statistic. US is getting truckloads of money from around the world into the stock market, into the banks. US is getting flushed with liquidity because Switzerland is now sharing with the United States the accounts that have been opened by US people. Guess where US is getting most of its money from these days? Switzerland. It's coming back. And so according to a recent article in The Economist, US is now the biggest tax haven. And forget Cook Islands and this and that. The safest place to keep your money and earn it, because all the stock markets are not giving anything. Japan is at negative interest rate. And so, Vivek, you seeing foreign money coming into US?
Yes, a lot of money coming back from India, especially with the rupee hitting 68.5. People are saying, let's move money back to the U.S. because that carriage rate getting 10% or 8% in India hasn't worked out that well.
Right, it never
We
will.
put it back in the U.S. and earn money here.
Right, yes.
So since the US has not signed the treaty, my understanding is that there are states like Nevada who follow their own laws and refuse to disclose the account information. Is that correct?
Nevada has always done a few things. One, they don't disclose who the shareholders are of a company. But if you have money in Nevada, what are you going to do with it? The interest in a bank in Nevada is 0.5%. So the money that's coming back to US by the truckloads is all coming to invest in the US because the stock market is down in China. It's down. It's less now than it was the day before Modi started. So the money is coming back to invest and coming back because they can't keep it in the Swiss bank accounts anymore. Yes.
I actually have a follow-up question on that. Is it better to have your company incorporated in another country like India and have a foreign entity registered in US? Does that help if you are over a certain level of revenue?
So for the last 30 years, if I couldn't come up with an answer to any question that a client ever asked me, I would think to myself that what would Bill Gates do? And the answer was one Microsoft in United States, and that's the end of the story. If Bill Gates was Indian, I am sure Excel would be in a separate company and his aunt would be a 5% shareholder, and PowerPoint would be in Ireland and his uncle would be a 10% shareholder, and so on and so forth. So you live in the US, you're going to be living a long life. And when you get older, you will not be able to shut down the companies that are not in the US. So I'm very, very biased to America and very biased to California. And if you're starting a business, let the headquarter, the parent be in California and then do whatever you want in the rest of the world. It probably works out the best. Tomorrow you'll get funding. You'll get better funding if you're a US company. And you know, India has rules like you need 2 shareholders. So all of our clients have gone to India and set up companies. And Ram Babu, my client, is 99% shareholder. And my office in India, we have 7 offices in India. The partners in India are the 1% shareholder. You need 2 shareholders in India. That's the kind of stuff India is still doing. And you need 1 Indian board member, and it takes 3 months to get anything done through registrar of companies. And with the speed with which the countries are moving and the business is moving and the economies are moving, we need speed as a very important factor. So nothing even comes close.
But don't you really have to register those offices if you want people to work for you
Yes.
from India?
Yes. The preferred model is you set up a company in California and you set up a subsidiary in India, in any city you want, and the Indian company will be owned by the US company. And don't do the typical desi thing to do, which is the Indian company is owned by the owner. And when you do M&A transaction, then it's not simple and neat and clean. You increase the due diligence work. Let's do what Microsoft has done. Let Microsoft own Microsoft India. Let Microsoft own Microsoft Germany. Let your California company own the Indian company. Let the Indian company be a subsidiary of the US company. It works like a charm in every aspect.
And that subsidiary could be again a corp, what's that?
Should be a corporation. Yes. And we need a second shareholder, so better than a relative is a lawyer you trust, because the relative, when you sell the company, the relative will want money and the lawyers will not. I once did a transaction where there was one person who was 0.5% shareholder and he was entitled to $12,500. And then just before the $50 million transaction went through, he said, I'm not signing till I'm given $500,000. I was promised. So The buyer says either you guys resolve it or we're yanking the transaction. What do you do? So we wrote this guy a check of 500,000, and he was an uncle, ex-uncle now, of our client. I remember this transaction because it was many years ago, but we were on the phone every night with Hyderabad, every night. Can you do something? Can you resolve it? Can you take 200? Can you? Nope. That's how it is. By the way, very few M&A transaction happen without somebody showing up last day and saying, hey, I'm owed money. We did a transaction, sold a company to Oracle for $100 million. And a month before the transaction, an employee showed up who worked there 20 years ago for a few months. And my stupid client in those olden days had signed a piece of paper that I'll give you 10% of the company. And of course, he was a bad employee, and he was fired, and he was paid money when he was fired and all of that. And there was all kinds of settlement, but no settlement. He forgot about this piece of paper. Now, what do you do with Oracle buying? So we settled, not for 10 million, but a few things to be done in writing.
Happened with Facebook too?
Happened to Facebook. And they settled for $65 million or whatever. And then they filed a lawsuit again that the settlement was bad. Right? Happens a lot. Yes.
Could you speak more about the M&A and how to do it right?
M&A and how to do it right, it's a very interesting thing. Talk about wealth creation and not wealth destruction. Probably the single largest wealth creation that'll happen in your guys' lives. The first thing I would say about an M&A is that, one, we need to run the company right. That helps avoid all these 20 things that you shouldn't be doing. Number two, run the business with one thing in mind, and I'll give you a tiny one-line thing that happened to me. I had a client for many, many years, one of my best clients ever, and we'd go to lunches a lot. And for 15 years, he paid for lunches. And it was a no-brainer. The bill would come. I wouldn't even offer. I'd stopped offering. He would pay, nice guy, and did a lot of work for him. He was my largest client. Then he finds a buyer, and we're going to sell the company. And the company's LOI says one line. This is March. The line says, we will pay you 8 times your net profit at the end of the year. Simple. Right? So, and it was going to be a $30, $40 million transaction. A few days go by, we're at lunch again. The bill comes, $30. And my client says to me, Navneet, if you don't mind, you've stopped offering to pay, so which is fine. But if you don't mind, can you pay this $30 bill because it's going to cost me $240? That one day, many, many, many years ago, that one line changed my life. That's how we should run our companies from day one. Why wait, right? Each dollar is, PE, right? The 4,000 public companies in the US stock exchange are selling for 15 times earnings. My client's company was sold for 8 times earnings. So imagine that lunch in a public company, $30 times 15. That's how valuable your gross revenue is, and that's how valuable your expenses are. To reduce them, that's how valuable your net profit is, and that's how you should run your company. And it's a dramatic difference if we run it like that. Don't get crazy over it, have your lunches, but so one company that's run neat and clean, the buyer can tell when they do the due diligence. The investment banker that markets you can tell and will be able to do a better job. And then a beauty contest. If you are a darn good company, then do a beauty contest. Schedule 2-3 days at a hotel. Ask all the buyers, potential buyers, to come, make presentations, and let them bid against each other. That's the best value you get. And then sell it to the best company, giving you the most amount of money with the least amount of earnouts and least amount of indemnification and least amount of shackles around your arms and legs in terms of non-solicitation and non-competition, and you should be back in business in a couple of years. And what specific thing about M&A are you interested in? Do you want to sell your company?
Not really. But I'm very interested to know how to merge it with another company,
Right.
and or have another company merge with mine,
Right.
and grow bigger in size.
Right. Yeah, very good idea. And you can only do merger of two companies if both companies have been running neat and clean. So first, give a notice to the other side. I went to Hyderabad last month to merge with a law firm in Hyderabad. Wonderful guy. We had a great conversation, spent a lot of time. Other employees of mine spent a lot of time with him. And we went to dinner, wonderful dinner. I was thrilled that it's such a great company, and I was very happy to merge with him. After dinner, we go to his room, his office, and he says, can we get engaged and not married right now? Because most of my business, I take black money, and you're not going to like it. And so give me an opportunity to clean it up. Give me a year. And I said, how about you stop taking black money? He says, no, I'm building a hotel in Vijayawada, Chandrababu Naidu's new hometown. And I need the black money because I can't build it without black. So I will talk about it merger next year. So if you're going to merge, then give notice to the other company, clean up time, the next 4, 5, 6, 8, 10 months, and then produce clean financials and merge. But I have to tell you something in respect to M&A. Next time you see a M&A conference happening anywhere, or some investment banker invites you that, hey, talk to us to see if we want to represent you, please go to these conferences. And please start a M&A conversation with a banker and with prospective buyers, because every time we've gone through a transaction and the transaction didn't go through, my clients later come out and said, I'm glad we went through it because I learned a lot. So when you do an M&A transaction and you go through that process, the kind of questions that are asked of you, you get an insight into your own business. And then you get very motivated that, hey, if I could just only do X, Y, Z, if I could just go from 10 million to 12 million, I'm going to get a higher multiple because now I'm in the next stratosphere. So there's endless learning. The buyers come and do an audit and say, hey, we don't like this, we like this. And they criticize your books and how you capitalize things and how you maintain books. So it's an awesome learning experience. So please go through it, even if you're not going to ultimately sell. All right, folks, thank you very much.